Investors can decide where to put their money into investments. It's essential to carefully weigh all of your investment possibilities. The conventional three core categories into which investments are separated are stocks, bonds, and cash equivalents. Each category contains a range of investments of different kinds. We won't talk about cash alternatives like money markets, CDs, or savings accounts because their primary goal is to safeguard your money rather than raise its value. In this video, we will take a look at the 7 types of investments you might consider for long-term growth, and what you should know about each. Before starting, don't forget to like and subscribe to our channel for more future updates. So let's start. How to purchase different types of investments. You will require a brokerage account for any investments you make. A brokerage account, which is distinct from a bank account, can be used to buy and sell investments. You can open a brokerage account in as little as 15 minutes, at which point you are ready to begin investing. To find the investments you want, you can use the tools on the broker's website. Many of them also include instructional resources to get you going. Number 7. Real estate management. You can invest in homes and real estate. If you regard all assets equally, public enterprises, private businesses, residences, ranches, and trailer parks are all valuable assets. Finding a home that is just half as expensive as it is worth is the most difficult aspect of real estate investing. If you can do that, real estate investing can be highly lucrative. If you don't want to deal with managing a large number of rental properties, investing in the stock market may be simpler and yield comparable or greater returns. Direct property acquisitions, whether residential or commercial, are one option for investors to build their real estate portfolios. The option to buy shares in real estate investment trusts is also available to them. Number 6. Stocks. A stock is an investment in a certain company. Simply put, a stock is a stake that you can purchase, or a little fraction of the company's resources and earnings. When a business needs cash, it will sell company stock, which investors can then purchase and trade. Stocks carry a higher risk than other investment options, despite the possibility of significant rewards. Businesses could go out of business or completely lose their worth. Now, let's quickly review how investors make money. An investor benefits when the value of the stocks they own rises because they may sell those equities for more money. Some stocks also provide dividends, which are regular payments paid from a company's profits to its owners. Number 5. Bonds. Bond investments lead to the granting of a loan to a business or government. When you purchase a bond, you authorize the bond's issuer to borrow your money and pay it back to you with interest. Bonds are usually thought of as less risky than equities, despite the fact that they may offer lower returns than stocks. The primary risk, like with any loan, is the issuer defaulting. This danger is entirely eliminated by the full faith and credit of the United States, which supports U.S. government bonds. After municipal and state bonds, corporate bonds are frequently seen as the next less risky option. Bond risk typically declines when interest rates rise. Due to the possibility of regular income distributions, bonds are a fixed income investment. Regular interest payments are made to investors, usually once or twice a year, and the entire principal is typically repaid when the bond matures. Number 4. Mutual funds. If the idea of picking particular bonds and stocks doesn't appeal to you, you're not alone. In actuality, investors like you had in mind when the mutual fund was formed. Through mutual funds, investors can purchase a variety of different investments all at once. These funds combine the money from several contributors, pool it, and then employ an experienced manager to invest it in stocks, bonds, or other assets. A mutual fund may invest in a particular class of stocks or bonds, such as government bonds or international equities, in accordance with a predetermined plan. For some funds, assets include both bonds and stocks. The degree of risk will depend on the investments the mutual fund makes. A mutual fund will give investors a portion of its earnings in the form of stock dividends or bond interest. There is a potential to sell the fund for a profit when the value of the investments it owns and the fund itself increase together. Keep in mind that buying mutual funds necessitates paying an expense ratio, which is a yearly fee. Number 3. Index funds. An index fund is a form of mutual fund that passively tracks an index rather than hiring a manager to make investing decisions. For instance, in an effort to replicate the performance of the S&P 500, an S&P 500 index fund will hold shares of the companies that make up that index. Index funds typically have cheaper costs because they don't have such active management on staff. the investments an index fund makes will determine the level of risk. Investors may benefit from this method since index funds may produce dividends or interest that is paid to investors. Investors may be able to resell their shares of the funds for a profit if the benchmark indexes that these funds monitor appreciate in value. Index funds also have expense ratios, but as was already said, these costs are typically lower than those for mutual funds. Number 2. Exchange-traded funds. An example of an index fund is an ETF, which seeks to match the performance of the benchmark index it monitors. They often have lower fees than mutual funds since, unlike index funds, they are not actively managed. The way exchange-traded funds, ETFs, and index funds are bought and sold is the fundamental difference between them. ETFs prices fluctuate frequently since they trade on a stock exchange. On the other hand, regardless of whether you purchase or sell, the price of mutual funds and index funds is fixed just once, at the end of each trading day. An ETF may be a preferable option if you desire more control over the fund's pricing, despite the fact that the majority of investors are ignorant of the distinction. The goal of investing in an ETF, like that of a mutual fund or index fund, is to increase your money's worth so that you can sell it later on at a profit. ETFs may pay dividends and interest to investors. Number 1. Options. An agreement to purchase or sell stock by a particular date and at a particular price is known as a stock option. Options provide you flexibility because you aren't legally compelled by the contract to buy or sell the stock. As the name implies, it is doable to accomplish that. In most option contracts, 100 shares of the underlying stock are covered. A contract in addition to the underlying equity must be purchased in order to exercise an option. The options contract can then be transferred to another investor or allowed to expire, or the shares can be bought or sold at the agreed price within the specified time frame. Despite the fact that options can be complicated, at their most fundamental level, you are just locking in the price of a stock whose value you anticipate increasing. If your crystal ball is correct, it will be advantageous for you to purchase the stock at a discount. If it is incorrect, you can decide not to buy it. In that case, you will just lose the contract's purchasing price. Before you begin investing, educate yourself on the various investment types, how they operate, and the dangers involved with each. You could suffer significant financial losses if you choose an uninformed investment strategy. Before thinking about investing in the stock market, speak with a financial expert to be sure your finances are in order. This is it for today's video. What do you think of our video? Feel free to share your thoughts in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.